Hi, this is Elliot Eisenberg of Graphs and Laughs here to catch you up to date on the latest in residential sales data for both Hillsborough and Pasco counties. And what can I tell you? You continue to be inventory starved. Inventory is tight, but in a change that's meaningful and important to watch, a year ago, it was tighter. If you look at median time to contract, it's now about 6 days as opposed to 5 days last year in both Hillsborough and Pasco counties. And if you look at months of inventory, it's gone up year over year by about 0.3 in both Hillsborough and Pasco for single fam, but only 1/10 or 2/10 from multifam. So I think people are moving a little bit towards multifam and away from single fam because it's a little cheaper, not cheap. Now, prices continue to rise even though rates are going up. And the reason is inventory remains very tight. Yeah, it's going up a lot in percentage terms. From 5 to 6 is a rise of 20%, but it's still very, very small. So even though rates are rising, we haven't seen it yet in the May sales data. We may well see it going forward because if you look at pending sales in both Hillsborough and Pasco counties, they're down a little bit. If you look at actual sales activity, it's up in Pasco, but down in Hillsborough as people move towards Hillsborough a little bit, as I mentioned earlier. And they move towards multifam in both Hillsborough and Pasco because it's a little bit cheaper. If we look at sales price to list price, it's 100%. Things are very strong there. And last but not least, if we look at prices, they are going up like crazy. Single fam prices are up about 30% in both counties. Multifam prices are up 40% in both counties. I mentioned earlier, I think people are substituting a little bit towards multifam because it's cheaper. If we look nationally at what's going on, GDP in Q1 was dreadful at -1.6. In Q2, it'll be 0.5% to 1%, a little better but not great. And for the rest of the year, it will continue to struggle primarily because of inflation. Inflation is really everywhere, and it's hurting wages as a result. Real wages aren't keeping up with inflation, and they're declining. And if you look at inflation, it's everywhere. If you look at goods and services, imports and exports, manufactured goods, energy, cereals, metals, it's across the board and everywhere. And as a result of that, the Fed's raising rates. They're raising rates quite rapidly. In their last meeting, they raised rates by 0.75 of a point. This month, they're going to raise rates by 0.75 of a point. In their next meeting in September, they're going to raise rates by 0.5 point, maybe 0.75 of a point, in an effort to get ahead of the inflation curve and begin to bring it down. This is difficult and it's important. For us, the good news is that even though rates are going to go higher at the Fed funds rate level, that's not going to translate into higher rates for 30-year mortgages. They've already gone up as much as they're going up. I don't think they exceed 6%, as I've said in the past. And that's the good news. The bad news, however, is that I believe we are setting ourselves up for a recession. Every time the Fed goes on a long interest rate rising cycle like it is now, to quash inflation like it is now, it has led to a recession every time since the end of World War II. So keep that in mind as you go forward. I think the chances of a recession between now and late 2023 are exceptionally high. That's it for now. I look forward to seeing you next month.